markets, the U.S. stock rally shows no sign of slowing down. The Dow and the S&P are set to rise further into record territory this session amid fresh signs of U.S. economic strength. New numbers show housing starts spiking 19% last month. This follows strong retail sales numbers and encouraging job data that was released yesterday. Optimism in energy markets too. Brent crude is on the rise for the fifth straight session and heading for a weekly gain of 7%. Signs of caution in the bond market, however. Yields, which tend to rise on signs of economic strength, have pulled back this week. This suggests that some investors don't yet buy the long-term growth scenario. Joining me is John Petrides. He's portfolio manager of Tocqueville Asset Management, and he joins me live. Great to see you, John.
Yeah, thanks for having me on.
Can you walk us through this movement in the bond market? We see the 10-year Treasury falling on Thursday. Usually when there's good news, you would expect to go in the other direction. What are investors seeing that maybe I'm not seeing?
Yeah, well, I think path of least resistance is that interest rates over the long term are going to go up. There's been massive stimulus pumped in the economy from central banks and from governments. The global economy is reopening. We're all doing more with less, which is good for profit margins, particularly for companies. So I do think that interest rates will go higher. But, I think in the short term, maybe they were a bit oversold. The inflation data, the core CPI number, which excludes gas and food, last week came out 1.6%. The Fed said they're looking for an average of 2%, so they're okay for inflation to overheat or at least go over their target for some time. So I think the fact that inflation has moved up and maybe there's some bait that inflation will spike, but I don't think investors are expecting it to spiral out of control. And those that may have thought inflation would spiral out of control maybe are rescinding that trade slightly in the short term, and that's why you're seeing treasuries catch a bid. Let's not forget, too, that there's no yield to be had around the world. So if you're a German investor and the German Bund has a negative yield right now, 1.6% on the U.S. Treasury looks quite attractive.
Yeah, let that think in for a minute.